Preparing for a IFRS 17 insurance contracts, GMM, PAA, VFA, CSM interview? You've reached Candy Mentor, and this video is for you. We'll walk through 12 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What is IFRS 17, and why was it introduced? The interviewer wants to assess your high-level understanding of IFRS 17, its purpose, and how it changed insurance accounting compared with the older IFRS 4 framework. While answering, focus on comparability, current measurement, profit recognition over coverage, and the replacement of inconsistent local accounting practices that existed under IFRS 4. IFRS 17 is the global accounting standard for insurance contracts, replacing the inconsistent IFRS 4 regime. The point is comparability. Insurers now measure obligations using current estimates, discounting, risk adjustment, and a contractual service margin rather than local actuarial practices. I would summarize it as moving insurance accounting toward an economic, service-based model where profit is recognized as coverage is provided, not when premiums are received. Question 2. How do you determine whether a contract falls within the scope of IFRS 17? This question evaluates whether you can identify an insurance contract based on substance, especially significant insurance risk, rather than relying only on legal form or product labels. Make sure to cover the definition of insurance risk, compensation for an adverse event, significant risk transfer, separation of non-insurance components, and common exclusions such as investment contracts. I start with whether the issuer accepts significant insurance risk from the policyholder by agreeing to compensate them if a specified uncertain future event adversely affects them. Legal form is not enough. A product branded as insurance may fail IFRS 17 if it only transfers financial risk. I would also check whether investment components, embedded derivatives, or distinct services need to be separated and accounted for under other IFRS standards. Question 3. Walk me through the general measurement model under IFRS 17. The interviewer is testing your understanding of the default IFRS 17 measurement model, including fulfillment cash flows, discounting, risk adjustment, and the contractual service margin. In your answer, talk about expected future cash flows, time value of money, non-financial risk adjustment, CSM as unearned profit, and subsequent measurement over the coverage period. The general measurement model is the default model for measuring insurance contracts. I think of it in 4 blocks: probability-weighted future cash flows, a discount rate reflecting timing and financial risk, a risk adjustment for non-financial uncertainty, and the contractual service margin. The first 3 form fulfillment cash flows. The CSM prevents day 1 profit recognition and is released as insurance service is provided, so earnings follow the pattern of coverage. Question 4. What is the contractual service margin and how does it behave over time? The interviewer wants to assess whether you understand the CSM as the core profit deferral mechanism under IFRS 17 and how it changes through accretion, adjustments, and release. Be sure to mention no day 1 gain, future service profit, interest accretion, changes in future cash flow estimates, coverage unit release, and loss recognition for onerous groups. The CSM represents unearned profit on a group of insurance contracts. If expected premiums exceed expected claims, expenses, discounting effects, and risk adjustment, that profit is not booked immediately. It sits in the liability and is released to revenue as coverage is provided. The CSM can increase with interest accretion and changes related to future service, but it cannot go negative. If losses exceed it, the excess hits profit or loss immediately. Question 5. How are discount rates and the risk adjustment used in IFRS 17 measurement? This question evaluates your ability to distinguish financial risk from non-financial risk and explain how each affects fulfillment cash flows, insurance finance income, and profit emergence. While answering, focus on present value, current discount rates, top-down versus bottom-up approaches, compensation for uncertainty, confidence level disclosure, and different impacts on insurance service versus finance results. Discount rates convert future insurance cash flows into present value and reflect timing, currency, liquidity, and financial risk, but not risks already included in cash flow estimates. Insurers may use bottom-up or top-down approaches. The risk adjustment is different. It is the compensation the insurer requires for bearing non-financial uncertainty, such as mortality, morbidity, or claim severity. Together, they make liabilities current and risk-sensitive, while their releases affect different parts of performance. Question 6. When can an insurer use the Premium Allocation Approach instead of the General Measurement Model? The interviewer is testing your understanding of the simplified PAA model, its eligibility criteria, and why it is commonly used for short-duration insurance contracts. Make sure to cover 1-year coverage, reasonable approximation to GMM, liability for remaining coverage, liability for incurred claims, owner's contract testing, and practical examples like motor or property insurance. The Premium Allocation Approach is a simplified model mainly for short-duration contracts. It can be used if the coverage period is 1 year or less, or if it reasonably approximates the General Measurement Model. Instead of explicitly tracking a CSM, the insurer recognizes premium as coverage is provided. However, incurred claims still require current estimates, discounting when material, and risk adjustment. It is common for motor, property, travel, and many annual protection policies. Question 7. Explain the variable fee approach and how it differs from the General Measurement Model. The interviewer wants to assess your understanding of direct participating contracts, the insurer's variable fee, and why IFRS 17 treats changes in underlying items differently under VFA. In your answer, talk about policyholder participation, clearly identified underlying items, substantial share of returns, insurer fee concept, and CSM absorption of changes in the variable fee. The variable fee approach applies to direct participating contracts, where policyholders share in returns from clearly identified underlying items, such as unit-linked funds or participating pools. Economically, the insurer earns a variable fee for managing those items and providing insurance coverage. Under VFA, changes in the insurer's share of underlying item returns generally adjust the CSM, rather than flowing immediately through profit or loss. That makes profit recognition align better with the service economics. Question 8. How are coverage units used to release the CSM? This question evaluates whether you understand the mechanics of recognizing insurance service profit and can connect actuarial assumptions to accounting revenue recognition under IFRS 17. Be sure to mention quantity of benefits, expected coverage duration, current and future service, systematic allocation, reassessment each period, and the judgment involved in selecting coverage units. Coverage units determine how much CSM is recognized in profit or loss each period. They reflect the quantity of insurance coverage provided and the expected period over which services are delivered. For example, if a portfolio provides higher death benefit coverage in later years, the release pattern may not be straight line. The key is that coverage units should represent service transfer, not simply premium billing. They are reassessed as expectations change. Question 9. How does IFRS 17 treat reinsurance contracts held? The interviewer is testing whether you can explain reinsurance accounting separately from underlying insurance contracts, including asset recognition, loss recovery, and timing differences. While answering, Focus on separate measurement, reinsurance as an asset or liability, CSM for reinsurance held, recovery of onerous underlying losses, and non-mirroring with direct contracts. Reinsurance held is accounted for separately from the underlying insurance contracts because the reinsurer contract creates different rights and obligations. The cedent measures expected recoveries, premiums paid, discounting, risk adjustment, and a CSM if applicable. One important IFRS 17 feature is loss recovery. If underlying contracts are onerous, expected recoveries from reinsurance can be recognized consistently. But reinsurance does not simply mirror the gross book. Question 10. What are the main IFRS 17 transition approaches, and when would each be used? This question evaluates your practical implementation knowledge, especially how insurers establish opening balances for legacy portfolios when full historical information may not be available. Make sure to cover full retrospective application, modified retrospective approach, fair value approach, data availability, impracticability, opening CSM, and comparability challenges during transition. The preferred transition method is full retrospective application, as if IFRS 17 had always applied. If that is impracticable, an insurer can use the modified retrospective approach, which uses reasonable approximations to maximize historical information. If even that is impracticable, the fair value approach sets the opening CSM based on the difference between fair value and fulfillment cash flows. The transition method matters because it affects future CSM release and reported profitability. Question 11. How did IFRS 17 change the presentation of insurance revenue and profit? The interviewer wants to assess whether you understand IFRS 17 financial statement presentation, especially the separation between insurance service result and insurance finance income or expense. In your answer, talk about excluding deposit components from revenue, recognizing services provided, insurance service expenses, finance effects, OCI policy choices, and improved comparability with other industries. IFRS 17 changed insurance revenue from a premium volume measure into a service-based measure. Amounts that are really deposits or investment components are excluded from revenue. The income statement separates insurance service result, such as revenue, claims, expenses, and CSM release, from insurance finance income or expense, such as discount rate effects. This gives users a cleaner view of underwriting performance versus financial market impacts, which was often blurred under IFRS 4. Question 12. If a group of contracts is expected to be loss-making at inception, what happens under IFRS 17? This question evaluates whether you can apply IFRS 17 to an onerous contract scenario and explain why losses are recognized immediately rather than deferred. Be sure to mention grouping by profitability, no negative CSM, immediate loss recognition, loss component, subsequent allocation of changes, and possible reinsurance recovery, if applicable. If a group is onerous at inception, IFRS 17 does not allow the insurer to create a negative CSM and defer the loss. The loss is recognized immediately in profit or loss, and a loss component is established within the liability for remaining coverage. Later changes in fulfillment cash flows are allocated between the loss component and remaining liability. If reinsurance held covers part of the loss, a related recovery may also be recognized. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.